Welcome everyone to the 2017 publication webinar of the Australian Benchmark Initiative. I'd like to thank you all for attending today. My name is Jamie McBrien. I'm a director of Optum2 and Opti BPO, and I'd like to thank our other sponsor, TAPS, the Association for Payroll Specialists. Today, what we're going to go through, I'm going to take you through an overview of what we did and how we went about it, the methodology we employed, a little bit about the 2017 survey, the reason you're here, some of the results around process maturity, what are people doing in the future, and what are some of the key metrics. I'll also talk about getting the report, how it'll be distributed, as well as report cards for those of you that participated, and a little bit about the 2018 study. Look, this is a one-way webinar, unfortunately. There's a lot of you on the webinar today. However, if you did have a question, feel free to type it into the Q&A box. I'll try get to it. If I can't get to it, feel free to contact myself directly, and I'm happy to answer any questions that you have about the survey, the results, or how best you can use this information to help you drive forward continuous improvement in your own organisation. Just a quick bit about our sponsors. Optum2. Optum2 is a consultancy focused on the assessing and improvement of finance operating models, process and structure, so helping people drive programs of change as well as process improvement initiatives. Opti BPO helps organisations plan, build and manage offshore teams in the Philippines. And TAPS, the Association for Payroll Specialists, is one of the original and oldest representation of the payroll industry here in Australia, with 6,500 professionals it represents. And we thank TAPS for their support and sponsorship for the last 2 years. In terms of an overview of what we've done, and why did we do this? This is now, we'll be entering the 7th year of the Australian Benchmark Initiative. So back in the early 2010s, we found most finance benchmarks were US sourced and not that relevant to Australia. We found the attempts on Australian benchmarks were intermittent and they lacked ongoing renewal. And we also thought that there's limited opportunities to share better practice on finance operations amongst Australian companies. Now entering our 7th year, we think we've become the leading source of finance benchmarks and better practice in Australia, and we're pretty proud of where it's gone, where it's got to, and I think where it's going to go in the future. So our objective is for us to build a set of finance benchmarks and facilitate the sharing of finance better practice between Australian companies. I think we all know, even in competitive industries, that there's no reason why we all can't share how to do things better. I think it rises all boats, and I think that that's important, and we can all learn off each other. In terms of the methodology that we employed, and the methodology we've employed for the last few years, an important part was to collect and validate any information that comes through to us. We validated for reasonableness. If we felt as though someone didn't answer a question correctly, we've followed them up, and we've had to follow up a lot this year because there's a lot more participants. We've then analysed that data, and we've added our own subject matter expertise. We consult in these process areas day in, day out, so we understand and know what good looks like, but we've added our analysis to it to apply to the results. We also hope then that the end result is a high quality report with detailed analysis. The report's been well received in all the other years, and a lot of people, I've been told, have been used it to build business cases to help facilitate change and to get organisational engagement on the next steps in their transformation initiatives. In terms of the timeline, we kicked it off in September last year. We, through the period of October, November, we had the study. People got their results in by the deadline at the end of November. Some of you lagged until December, but we chased you. We've then produced the results over that intervening period, and to be here today, where we've got all 3 studies done, ready to go, and the results as part of this publication webinar today. Look, the numbers have been growing. We thought we were plateauing for a little while there. You know, in year 1, we said we'd be happy if we could get 20 companies participating. We had 34, which blew us away. Since then, it grew and jumped, and for a couple of years there, seemed to think we'd exhausted it. But in 2017, I'm not too sure if there's a greater improvement on a greater focus on improvement or a greater focus on the need to be effective. But all of a sudden, the numbers in the survey have jumped, and so there's 130 discrete companies that have participated this year across a variety. Some have only participated in one or two areas, and some have participated in all. So all up, over 300 survey responses. Apart from the fact we need to collate the data, we're extremely excited at that number of companies that are involved. As well as that, when we look at the companies and we look at the type of respondents, this is just each of the surveys broken down. As you can see, these are the medians. The median revenue, employee number, are both, show that not only do we have a quantity of respondent, I think we've got a quality of respondent. We've got a good mix as well of ASX, multinational, private, government. So we've got a good cross-section across the 130 separate businesses that are part of the study. So we think we're really hitting the mark, and we think that the numbers that we're producing really are representative of the Australian landscape. In terms of the structure of the study and the structure of the results, we collected some general company information. We want to understand who you are. We want to understand a bit about your management operating environment. How do you structure things? How do you report on performance? As well as process maturity, where is that at, and what does that look like? Importantly, what are you doing in the future? And this is where we find some of the best insights, we think, and of course the benchmark metrics, which everyone loves and likes to use. If we now jump into the part that you're all here for, which is the 2017 survey results, what we're going to do is step through each of the different areas of study of purchase to pay, order to cash, and receivables, and have a look at each. If we look at the structure of each across them, most organisations have built a shared service at this stage. There's not many now that are operating in a decentralized environment. So most organizations have adopted a shared service. Offshoring and outsourcing is a growing area, and not because that's just part of our business as well. But if we look back to the 2011 studies, a lot of that was on 0 or 5, and we can see a definite uptick from 1 and 2% in 2011 and 3 and 4 in 2012 now to 17% in payables, 24% in 12% in receivables, and 14% in payroll. So definitely some growth there in terms of outsourcing as an initiative in these core finance process areas. All the high performers, though, had well-defined standardized processes. That makes sense. But it was a one-to-one relationship when we look back through the data and the results that we got from that. If we look at standardized processes, again, this is where we've seen significant improvement over the years. Most organizations have adopted standardized processes across these core transactional areas. Receivables, though, is the less standardized, with a number of people identifying that this is a key function for improvement and where they really want to focus their energies. So not to say that payables and payroll don't have opportunities for improvement, but a lot of organizations said that receivables is the area of focus for them in the upcoming year. In terms of SLAs, SLAs for me, they sound cumbersome and sound onerous, but really all they are there to do is dictate the partnership between the finance organisation and the business. We think they're important to get them right, but only about half had SLAs in place, and those did have them said they could improve. I think getting these sort of things in place helps create a mutual obligation. When we do finance reviews, one of the easiest observations for us to make is that the business stakeholders have indicated that finance is a black box with limited or no feedback. And that's due to unaligned expectations. Service level agreements allow you to sit down and agree what is the interface, what do we expect from the business, and what will we provide back in what time frame. They don't need to be complex, but they do need to be well thought through, and that does provide us a baseline against which to measure ourselves and also then report back on our own performance. If we step then into each of the functions that were under study, what I'm going to go through first is just some of the functional observations on purchase to pay, and then the other areas, and then we'll come back to the future strategy and some of the metrics. In terms of purchase to pay, some of the key findings, Standard trading terms. Only half of respondents had standard trading terms. Of those, overwhelmingly standard terms are 30 days. Look, I find it kind of surprising that organisations, medium to large in particular, but small to medium as well, are sitting there accepting terms as they come along rather than enforcing their own terms for working capital management perspective. We think it's important to get standard terms. Most organisations have standard terms here in Australia of 30 days. We know, of course, of large businesses that push that out even further. But getting standard terms, allows us to forecast cash better. It allows us to manage our working capital better. And it allows us also to make sure that we really consider those suppliers that are asking for more as a point of negotiation. It doesn't mean that you can't veer from the standard, but if you are, I think that they're the sort of things that a CFO or a financial controller should be signing off on and not just being accepted as that's the way that they work. So look, an easy area we think of improvement there. The high utilisation of purchase orders. This is something that's definitely increased over time, although we still deal with organisations that you need to convince them of the benefit of the purchase order, but 89% have POs in place, and most of them have online purchase orders with associated approval workflow. I just think it's a basic fundamental part of having a well-managed business is having POs in place to ensure spend is pre-approved. It helps you manage the liability and facilitates that three-way match. We often get the argument to us that, well, it adds more work. That's a little bit misleading. No, it adds work up front to make sure that we've got the commitment recorded, rather than putting that work in the back end to chase where is the authority for that. So it doesn't add any additional work, and it gives the organisation a greater level of control of where its spend is going. And look, I couldn't see myself or anyone that works for us ever running a business where this was not a critical and important part of how we ensure a basic control environment. Purchase orders are being used for all spend type. Again, lots of people would say, well, it's great if you've got inventory, but who cares? We're a services business. Purchase orders can get used for all types of purchases. Those ideas, I think, are a little bit outmoded. And we observe that it's getting used across all categories of spend. So we think that a purchase, whether you're engaging a lawyer to do a piece of work or whether you're buying some widgets to go into your manufacturing plant, the importance and the practicality and the reasonableness from a management perspective to have purchase orders in place is all the same. Here's one that's increased exponentially as well over the last couple of years. Credit card usage is high. I still come across a number of arguments from clients as to why there's high risk. There is higher risk in invoices without a purchase order and without proper supply checks by 1,000 miles than having credit cards that are handed to specific individuals and are well controlled. It's interestingly how those that argue the most against credit cards often have the weakest invoice approval processes. For me, credit cards provide an efficient method, and for us, an efficient method of payment, particularly for low-value items or certain repetitive goods. We can see it here with 98% of you. In that 98%, though, there's some of you that use it more than others. For some, it's just the CEO and the CFO. For some, it's widespread. I think there's probably a nice middle ground. We went to one organisation with 1,000 people and they had 700 credit cards. That's probably gone too far. We need to think about who makes these types of purchases on an ongoing basis and set them up appropriately. Another areas that keep finding on P2P is that goods and services are being receding. The two-way match is dropping off, and people are looking to three-way match everything, which makes sense. And again, you get the argument, well, you can't goods receipt a service. Absolutely, you can. But there's still some that don't bother with the receipting process. For me, it's part of the control framework and an important thing to consider. Most of you now are receiving invoices centrally, which goes with the fact that most of you have set up a shared service. Email's increasing, but there's still a fair few that accept these things manually. There's some that indicate they still receive it by fax. I personally didn't know fax machines still existed or you could buy one, but some of you are receiving them still by fax. I think removing these sort of steps is critical, and it's fairly straightforward and easy to start saying we want it through one channel, and that one channel is email. 89% of you request suppliers to quote a purchase order on their invoice, which is a good thing, and I would look to reject those that don't comply with that. Um, uh, Getting these efficient processes in place, if we've got purchase orders up front, appropriately goods receipted, in the perfect world, the payables process then becomes extremely efficient. Of course, in the perfect world, it doesn't exist, but if we can still get 80% of invoices through a smooth, straight through process, we've built an efficient payment process that all we need to do then is focus on exception management. Invoice automation. This is an interesting one. We've been around this space for a long time. The idea of invoice automation has been talked about, I think, since the early 2000s in my career. Still, a lot of you haven't embraced automation, and it has been growing, but it probably hasn't been growing at the rate we would have forecast 10 years ago, where we thought everything would be automated. I think that there is some barriers in this space, but I think there is improvements being made, and we are seeing organisations start to adopt it a little bit more. Critically, to get this right, though, if you don't have good processes, automation is not going to help you. You're just going to be managing exceptions, and it's going to be a waste of your time. So, critical to get the processes sorted before we move on to anything like this. So, the key areas in purchase to pay that our respondents indicated were impacting their performance was still the high level of manual work that was required, issues around getting purchase orders right, a lack of system capability, issues with good receipting, and business engagement and support of P2P. A lot of these things are around getting some business rules right, making sure that we set things up straight. Also around things like purchase orders, making sure that we have people that are dedicated to ensure integrity of the purchase order, but then also getting workflows set up to make that work. But look, these are the top 5 areas impacting performance for purchase to pay. The next area of functional review was payroll, and these are the areas that we looked through from a payroll perspective. Some of the key findings that the employee setup is still highly manual. You can see a bit of a theme across the areas of study here. There's still a whole lot of manual processes. Again, early 2000s, the story of the paperless office that we all heard about. I think all of us have only seen paper increase, but there's still a whole lot of manual setups. Getting these things right is important. We often go to places and see compendiums of employee files sitting around the place. Getting it from manual form to electronic workflow and approval has a whole lot of benefits from an efficiency and a management control perspective. As I said just before, you often see hard copy files all around the place. The HR file is a critical piece of information. It's confidential. There's information in there that needs to be controlled. If there's an issue, it's information that needs to be retrieved. Again, it kind of shocks me when I see this information sitting around organisations on desks in loose filing cabinets in a variety of different places. So getting that online and automated, I think, is a critical requirement. We've got files kept in a variety of different formats. There's lots of kept on scanned and put on shared hard drives or document management systems, but less so in HRIS type systems, which allow you to make sure that you've got everything and it's complete and it's there and it's done. But still, the hard copy format is still the dominant. And again, if you'd asked me, just like payables, if you'd asked me 10 years ago, would this be the case? I would have said no way. So there's also a cost imperative. If you sit there, property, as we all know in Australia, is expensive. When you sit there and you look at these big rooms filled with files, the business case is pretty easy to stack up. If you sit there and you go $400 a square metre and we've got a 10 square metre room, that pretty much is an easy justification as to why we need to get these documents into an electronic format, just from a basic cost perspective, before we even consider control, efficiency, and other reasons for having that in place. Timesheet standardization. Look, timesheet has improved. We've noticed this, that most of you have got to a standard timesheet. Again, this is fairly important, but again, even the next step is to get it automated and online. So most of you are moving towards a standard timesheet. And I often hear reasons as to why this can't be the case, even though the payroll system or the time and attendance system, where the information is getting entered into, has the single entry screen. People still tell me why we can't get to a standard timesheet for a variety of reasons. And I think, of course, we can. Time and attendance capture, it's still highly manual. Again, I'm being a bit of a broken record here, but 10 years ago, I would have said all of these issues are sorted, and they're not. They're still highly manual, and organisations moving to automated time and attendance are still lagging. And remember here too, the median revenue is $800 million. The median headcount is 1,200 people. We're not talking about small business. And in fact, if I looked at the smaller end of business, they're actually often better than the bigger end of business. I think maybe because they don't have some of those barriers in terms of using maybe new innovative cloud technology that sometimes some of the larger businesses still have concerns around risk on. But electronic time and attendance, it provides better control, efficient collection of data, and allows us to manage exceptions. And we've seen people who have implemented these types of systems that have actually seen their payrolls decrease because previously information was coming through and slipping through because the focus was on getting the data in, not reviewing it and following up on the exceptions. Payslip delivery methods. Look, 75% of you, employee self-service is increasing in usage. I can't imagine working for an organisation without having employee self-service in place, but they're still getting delivered in a variety of different methods. And the reason these don't add up to 100 is that a lot of you still offer multiple methods of payslip delivery. When I look at this, I think, mail, really? Can't we just quit that and let's move everyone onto ESS or email? Those first three categories where there's still a few of you doing these things, are areas where I think they're pretty easy to stop doing. I've been given a variety of reasons as to why we can't. From the employee doesn't have access to email to. I've even been given the excuse that that if I get it on email, my wife will see my payslip. And everyone might be laughing on the end, but we've actually heard that as a real reason. It's not a real reason. These reasons need to be overcome, and if we're going to be efficient, we need to move to the electronic method. The key areas then impacting performance for payroll, it's the manual work and the manual rework, from anything from timesheets to onboarding to terminations, all things that some organisations have automated. The lack of system capability around ESS and providing other information back to our customers or our payroll customers, being our team members, accuracy and speed of time and attendance, business engagement to support payroll, and some issues with data integrity. So they were the top 5 areas with some other reasons there falling down below that. Poor policy, quality of staff turnover. So they were the top 5 areas from this year impacting performance in payroll. In the receivables area then, some of the functional observations, most organisations had a new account process in place, and most people said the process was pretty good or rigorous. This has been an improvement area over the last couple of years, whereas before some people didn't have much of a credit assessment rigor, and I see people ratcheting this up and getting some improvements in place. In terms of credit assessment factors, this here gives you a percentage of who looks at what. 72% are now doing credit reference bureau checks. Now that's a big increase from previously. And it's interesting as things tighten, how people actually start to check more of these things. So getting out there, not as many of you doing credit scoring or personal guarantees, but some of you are doing that. So this is definitely an area where we've seen a tightening up over the last couple of years. But again, three different areas of study, 3 different general themes. Coming back to the old manual file across multiple locations of where the credit file is located, electronic and hard copy. Again, these are a critical resource that are important for us to keep, and a lot of them are still sitting around manually in different places. On the manual customer, the customer invoicing and statements, a lot of those are still manually sent out to people. The only person that sends us things anymore manually is our accountant, who we joke with continuously that if he wants them paid, send them to us electronically. The point is, any large organisation, if we remember back to the payables study, is looking to receive these invoices electronically in an email format, which gets it into workflow, which gets it through an approval process, which means you get paid. In the end, large efficient organizations aren't making emotional decisions on how they pay or how and when they pay suppliers. They're making them based on business rules. And one of those business rules is that you need to get into the front end of their workflow process. So it kind of shocks me that a lot of you are still sending out manual invoices, which could go into the never never, including people's desks around the place, or just simply not get through the mail process. When really the best way for us to get paid is to get these things out electronically to the right place that we've requested, and then it gets into their workflow such that it then follows their business rules and payment happens. Standard trading terms for receivables reflecting the opposite side of the payables study. Most people have standard trading terms of 30 days. Really, the vast majority of you did. So you can see that even the upper quartile was pretty much the case. So that seems as though that is the standard trading terms. Early settlement discounts, not many organisations offer them. For us, I think they create an administrative nightmare and a burden. For some businesses, though, it does make sense. And some of you only offer it for specific customers. So it's not a big part of the Australian landscape. If you compare this against a US study, in the US, you'll find that this is prevalent and a lot of organisations do it. So again, different markets, different ways that we operate. But in Australia, we don't see it as a big part of our landscape. Standard payment terms are enforced. 89% of respondents felt their processes, though, were average or strong in the enforcement of standard payment terms. Standard payment terms are pretty important and pretty important to enforce. I think we all know those that follow up the least probably get paid the slowest. So I think getting out there to make sure they're enforced. Everyone knows who the people are that collect hard, and that's important. Collection methods are strong. There's a variety of different methods that are getting used out there. Nearly all of you are using telephone calls, and reminder letter follows up. There's a lot of automation you can do around this, and collection agencies and lawyers are still getting heavily used. So look, I think that this is an area of improvement as well over the last couple of years in terms of the different channels being used to make sure that we collect our monies appropriately. There's still a lack of collections automation. And we find this when we do reviews of receivables management processes. There's a plethora of spreadsheets that people tick off and check, and a lack of automated systems. Again, if you go to the smaller end of the Australian market, of which some of our clients are, we've got a broad range from small to large, you'll find that they have a highly engaged and automated follow-up. They don't have the teams big enough to follow up manually. So getting automated follow-up and collections automation is important in terms of the escalation process. We also all know, and it's readily seen when we work with clients and we implement a receivables process, that the minute you start connecting with people and reminding them is the minute that action starts happening. A lot of the time, someone might have been completely honestly have forgotten about your invoice, left it on their desk, left it in their email, and the reminder is the prod. So getting these processes set up to escalate based on due and then rapidly thereafter, we think is pretty important. A manual system means that you're only going to focus on some key ones. You're going to forget the small ones. If you look across the board, we need to focus on all of them. And if that means segregating our market and sitting there and going, well, we've got different approaches for different customers, that's fine. We worked with one customer and we sat there and went, you've got 4 groups of customers. You've got the big end of town. They have a kid glove process. You've got the next level down that's got some follow-up calls and some other discussions. You've got the third level down, which has some automated emails and some escalation. Then you've got the 4th level down, which is fully automated until a certain point in the collections time frame, say 90 days, where then it goes straight to an escalation point. It's not a one-size-fits-all, but important to define those processes rather than just make them up as you go along. Over the last couple of years, though, we've seen an improvement in the days sales outstanding levels. Always got to be important to make sure I define that. I often get asked afterwards, what is it? So days sales outstanding, so how long the sales have been outstanding after invoice as a weighted average. 46% of you have experienced improvements in DSO. If you look at it, and they're a critical indicator of cash flow. If you see DSO blowing out, you take your money out of the Australian economy, it means that people are slowing down payments, which is a concern. I'll talk a little bit in the metrics in a few pages' time about what the metric was around DSO. So around collections or receivables as a whole, the 5 top areas, again, we're seeing that common theme of manual work and lack of system capability, some issues with billing, and some business engagement to support collections. And as I've looked at that, I've realised that's actually the top 4. Number 5 is issues with data integrity. There's and look, I think that goes without saying across receivables and payables, critical and not that hard to do, to review those master files, to get the information correct, to remove duplicates, to make sure we've got things in place. I think is a pretty important initiative that all of us should be doing at least every 1 year, 2 years at the worst. If you've been sitting here for 2 or 3 years, you haven't done a review of your supplier master file, I think you need to take a bit of a look at yourself and think about when are we going to do that. On the supplier side, I talk about fraud, and when we see fraud, it's typically on the supplier side. It's typically because the master file has been corrupted, and there's been a lack of control around those processes. There's some easy methods out there to do these cleanups. You don't have to do a spreadsheet and sit there and tick and bash. They're fairly cost effective to get out there and get these things right. In terms of the future strategy then of where are people heading in each of the areas of study, around the P2P space, a key initiative is standardising processes at number 1, and documenting procedures. So interesting that this one's stayed up top for a fair while now, that while most of you have standard processes, you feel as though you could further standardise, and that's going to be an area of focus. And that was the number 1 priority for the next year across the board. Invoice automation and workflow. The ones in red are system changes, increasing purchase order penetration, and policy definition. If we look at that top 5 as a group, these are things that don't, look, the system changes might need a high level of business case to get across the line with a variety of stakeholders, but getting processes and procedures in place, improving purchase orders and policy definition are all things that we can control ourselves to drive as an improvement initiative without the need for a significant level of business investment. There are also things we can address quickly and rapidly. Changing ERP or implementing new systems, we all know takes time. These are things that we could all get on with pretty quickly, and if help is needed, of course, there's a lot of organisations that could do that, and we're happy to take your call on that. So these are the key areas, and if you look down, one of the ones we've now put on the bottom there is robotics, and I'm going to just make a comment on that in that 2 years ago, I thought the idea of robotic process automation was something that kept junior people in large firms busy between client engagements to write papers on. But we're definitely starting to see some of the benefits of robotic process automation. We've been doing a few engagements recently where it has been included as part of the scope. And while it's sitting down the bottom there in terms of future strategy, I'm going to make the forecast now for the next couple of years. It's something that we'll see creep up. It's also something that's I've learned over the last couple of years that's not just needs to be confined to the big end of town. There's a lot of small organisations that are doing quick, rapid automation engagements to remove some manual steps and manual workflows to get those addressed. So just a call out to something, come back and test me in a year's time to see how that's going and if it's making any progress off the bottom of the ladder. In terms of the future strategy around payroll, number 1, employee self-service and getting that in place. I think that we all know that not only does that make employees happy, it takes a big burden off the payroll function, who are often answering queries, be that from an employee, from a business unit, from a manager on information. Critical to get in place. Next is getting time and attendance systems in place and getting that automated. Documenting procedures, again, jumps up into the top 5 as it has previously, and getting that down. It's rare for us to go somewhere, do a review and say, you've got fantastic procedures. Look, it does happen. Some people do. It's definitely an area where I think all of us, if we took a good hard look at ourselves, could put our hands up and say, perhaps we need some improvement there. Getting things into the electronic employee file, as well as improving payroll reporting and reporting back to the business and reporting on ourselves as well. So they're the top 5 for payroll. The top 5 for receivables, and sorry, I'm just taking a quick pause because my my webinar button was across the top 5, and again on receivables here we seem to have put the top 4, so I'll take that as my mistake. DSO reduction is still a big focus, that even though we're seeing DSO reducing in Australia over the last couple of studies, actually over all 6 studies that we've done, it's definitely an area of focus. We've seen organisations that are focused on improving their receivables management processes drastically reduce their DSOs. And a nice way and an easy way is to sit there and think about the bottom line impact that every day of DSO has on your organisation. It's one of the areas where us as finance professionals, and I count all of you as finance professionals, whether you're payroll, payables, receivables or otherwise, it's one of the key areas where us as finance professionals can help hit directly the bottom line. By reducing DSO, we're increasing working capital, which has a bottom line impact in terms of being able to have more capital available to deploy for other reasons. A client we worked with was at 62 days. Over time, they've pulled it back to 38 days. They've been able to measure for each of those days how much that adds, and they report back on that, and that's a big number for them. Again, standardizing processes comes to the fore, and remember, standardizing doesn't mean one size fits all. It doesn't mean one process. It means a thoughtful process that considers our different customer requirements, but we've got it clearly defined. Getting online invoices and statements makes sense, given a lot of you are still sending things out manually, and documenting procedures comes up there as well. And number 5, below the line there, some improved receivables reporting to ourselves and back to the business so we can make the right decisions around managing our own receivables. So some of the cross-functional themes that we saw across all of the studies, some of these I've harped on a bit already, so you've heard from me a few times. Management reporting, so improving the reporting of each of these functions so we can make better business decisions. Getting some good operational reporting in place. It's a lot of the time we do reviews and people will say, such as they're not performing, they're not doing this, and then we ask for measures and metrics, and those measures and metrics are not available. We then do collect those measures and metrics and we report on them for the first time to actually indicate that maybe the business isn't doing as bad as what it thought, but it's unable to back it up because it doesn't have the information available to do that. I think it's really important to get that in there as a baseline, particularly if you're going to start an improvement initiative, and as you drive that improvement over time, be able to see that actually come through, and then report back to the business and say, well, look, our cost per invoice has gone to here, our pay slips per payroll FTE has gone to there. We talked a fair bit about standardization and documentation. It's been a consistent theme for 5 or 6 years. It'll probably be a consistent theme in year 7. And automation, a lot of you are focusing on how can we better automate. So the metrics, which is what a lot of you are here for, I know a lot of you do use this as the basis of your benchmarks and your business cases back to your executives. Critical, though, I think, for metrics is to make sure that you understand there's a range of assumptions that are used, that are behind them, and we need to look deeper into, well, what does it actually mean? So in terms of the metrics for each one, we've had good, average, and poor. Good being the top quartile, poor being the lower quartile, average being the median, across the respondent base. So if we look at purchase to pay first, the invoices per full-time equivalent, for me, this is the key efficiency measure for an accounts payable team. 11,200 is the median, 17,840 invoices. So this is the number of invoices processed in a year. We have respondents and we have clients that far exceed this. If you look at the top end, there is organisations doing 35, 40,000 invoices per year. I can say, what do they have in place? Strong purchase order penetration and integrity, well receipted, reporting well on itself for things such as open purchase orders and purchase orders not receipted, or purchase orders invoiced not receipted. They've got those processes in place. They've got workflow. They've got a single shared service, and some of them are reaching that 35 to 40,000 range. Purchase order penetration keeps going up each year, and we want purchase order penetration, but we want it with integrity, and that's happening. So that's good to see. In the actual studies themselves, there is more metrics than this. This is just a snapshot. So when you actually get the studies, there'll be more in there. Around payroll, there's two key measures here. There's headcount processed per FTE, which takes the total number of employees divided by the number of payroll FTEs. And FTEs is full-time equivalent. That's a word I often use and get asked to define it afterwards. So full-time equivalent. The payments processed per FTE takes into consideration the differing pay cycles. So you might process one person in a month, but if it's a weekly pay cycle, you're processing 4.12 times in a month for that one person. So it takes into consideration that increased workload. So I think both metrics are useful because and looking at both of them gives you a bit of a picture of where you sit. On the receivable side, DSO is sitting at around 41 days. Interestingly, we did an engagement for an organisation. Someone in that organisation felt as though our metrics were not a fair reflection, and they felt as though they should not be relying upon the metrics we provided. So they engaged Dun & Bradstreet. This is last year. Our metrics back then were 42.3 as the average DSO. Dun & Bradstreet's came back at 42.2, which filled us with a high level of joy, not only an indicator to this client that the person was the person was maybe misled, but also that we'd also got a good, fair reflection. The other one too is the number of electronic payments that have been made. So that's been increasing over time now at 92%. Look, we really should be aiming for 100% for this. I know there's one or two things we can't pay electronically, but really, if you're sitting down at 75%, I think you've got a lot of work to do, and you should get on with it. Sorry, my presentation's just stopped. Report distribution, and one of the questions that's been asked on the Q&A on the webinar is, will this presentation be distributed? We will put a copy of the video of today's presentation on YouTube, and I will send it around to everyone to be able to watch. We won't send the whole deck around. Our arrangement is that those that participate get a copy of the report for free, and we thank them for the effort that they've put in for the participating in the study. For those of you that didn't, we'd like you to participate next year. There is an opportunity to buy the reports and to buy the information as well. But our view is that it's fair for the 130 companies that participated. They put the effort in to get the results and the report and the data back. So while we won't distribute the presentation wholesale, it still will be on YouTube, and feel free to watch it and grab what you want from that. And we'll make sure that YouTube video goes around to everyone that's on today's call, as well as our broader audience. What do the reports contain? The reports are each in 30 to 40 pages of detail around better practice, what we think is important. It includes metrics, includes some information as well on how things should look. It includes some analysis and insight on what we're seeing and how things work. So a whole lot more than I've had the opportunity to talk to you about today in the 60 minutes that we have. So it goes through each of the different areas and provides commentary as well. And we've only picked out 4 or 5 of the data points for each area of study. That's all we have time for today. But the reports, we asked over 30 to 40 questions in each study. So each question's got some different analysis, as well as some cross-analysis in terms of the data from what we can conclude from what we've been told. It's got the future strategy information in there and some thoughts as well on what we see the future as being and where people are going. So in terms of the report distribution, for those of you that participated in the study, you'll all get them on Monday. We'll send you out a link where you can download them from. So look forward to that. If you didn't participate and you'd like to purchase the studies, you can go to australianbenchmarks.com where they'll be up there for sale. Our intention in selling them is just hopefully to cover our costs, given there is a fair bit of cost involved in delivering this, and participants get it for free. So hopefully we can continue offering that into the future and grow the number base from the 130 now. Each of you too will get report cards by next Thursday, again for those of you that participated, which takes some of the key metrics and measures what you told us against those key metrics. So we found this pretty valuable. And as well as a bit of an offer, we are often get engaged to do reviews and assessments of all these areas of study. We provide not only the information in terms of these benchmarks and better practice guides, we provide our own subject matter expertise in having delivered these sorts of engagements across a number of different companies across Australia across the last 8 to 9 years. For an accelerated assessment over 10 days, which ends up in a detailed report, it's normally $15,000. If you did want us to come do that review for you, for those that have participated this year and those on the webinar, we'd reduce that to $9,900. Again, a detailed report that goes through process, structure, and system opportunities, as well as provide you a future state operating model and a plan for the future. So a short, sharp piece of work to get you started and to get you going on your own improvement initiatives and what they mean, and backed by real data. As well as that, one of the key things that we talked about is that's missing for lots of you is standard operating procedures. We have a product called OptiDocs, which allows you to rapidly and cost effectively build standard operating procedures. We use some tool sets and some automation to help capture workflows, capture what you do. We then have an offshore team that helps us transcribe, narrate, and build those procedures for you. We do it rapidly. We turn procedures around for payables, receivables, and payroll in days, not weeks. And it allows you to take you from a baseline of nothing to something really quickly. And we think a quality product that a lot of people don't have. Feel free to contact our websites there, but feel free to contact myself directly if you'd like to discuss further how we could rapidly and fairly cost effectively get this in place for you. So look, all these things, hopefully just a little plug there at the end. But in terms of the 2018 benchmark study, what we'd really hope is that those that didn't participate and are on this webinar see the value in what they've seen today, and they look to participate next year. That's the biggest sale we can have, is to get more participants to grow our number base from 130 to beyond. We'll be launching the 2018 study in September. If you want to ensure we contact you at the launch, visit the site, fill in the contact form. You'll go into our database. We'll keep you updated. We'll also keep you updated on other things happening through the year as well around benchmarks and better practice and communities of practice. If you want any insights or input as to how you can deploy this, some of this thinking into your own organization, we are always more than happy to spend some time with you. Come have a coffee or a meeting just to talk through what it is that your requirements are. So feel free to reach out to us at any point in time if you'd like to discuss it further. So again, I'd like to thank our sponsors. This only comes together through the effort of a lot of team members who put their time into this. We hope the quality of report you get meets your expectations. We are always more than happy to take feedback on how we can improve it, where we miss things, and what we could look at in the future. We think the reports have evolved over time. We think this year's report is the best report so far, but you'll be the true judge of that, and we'd be happy to have your judgment back on us. So thank you again. We've concluded in the time frame we said we would, which is always a positive. I'd like to thank everyone that's participated this year in the Australian Benchmark Initiative, and we look forward to you participating next year. And I hope I get to speak to most of you in person over the next period of time. So thank you. My name's Jamie McBrien, and thank you again for being here today.